Hey guys, hope you're well and welcome to this video. In this video, I want to discuss something quite important, which is the #1 mistake that traders make. And possibly it's a mistake you might have made. Actually, it's one mistake that I've made as well in the past. Almost every trader, every professional trader has made this one mistake. And I want to tell you about it in this book by Linda Rachke. She's a fantastic trader who I interviewed recently. For those of you who may not be aware, Linda Rachke is one of the world's greatest traders. She was interviewed in the book Market Wizards by Jack Schwager. Now, in this book, Trading Sardines, Linda says something quite interesting. I want to read you just an excerpt from this book. And she says, she quotes her friend saying, "It's never a problem getting into a market. It's always a problem getting out when you need to." And she says one of the most important lessons she learned, one of the mistakes she learned, and she said, never get so big that you can't get out when you need to. And she says, traders think the game is about the conditions of getting into a market, but you can get into most markets anytime, but always make sure there's an exit. Bottom line is what Linda's talking about, again, in this book, Trading Sardines, which, by the way, I've just started reading, and it's a great book so far. Linda's saying, look, one of the things that can destroy most traders is over-leveraging or over-trading or indeed piling a very big position size at the very start. So what's the solution to it? I want to explain to you how you can get around it, and there is a solution to this. Not the only one, but there's one. Let's take a look at this first chart. So you can see what I put here. What might be a good way to resolve this issue is when you initially enter the market, your first entry into the market, especially if you're feeling nervous or if you're not sure about what might happen next, especially if it's after a major drop in the market, it's always a good idea to start, buying with a small amount. Your entry can be with a small position size, with a small amount, not a huge position size. Again, as Linda was saying, never get in with a large amount of money, because what could happen is liquidity could dry up and you could end up with a huge loss. So what you can do is get in with a small amount and add to it when a trend begins to develop, when a trend like a staircase pattern like this, add every pullback. Here's an example for you on this chart over here. So take a look at this. As an example, I put here when the last time, for example, when the market develops a bottom, puts a double bottom pattern, breaks resistance, breaks with a 55 EMA on the chart, that red line you see there. So what we could do is at that point, we could add a small position. Let's go to the next chart. I can just show you that. So we can go in with a small entry, a small buy position size, all right? And we can put a stop loss right underneath the previous lows. So again, we don't go in with a large position size, a large amount of money, only a small position size, something we can be comfortable with. So in case the market goes against us, it doesn't matter. We won't lose a lot of money, right? So a small position size, and then once we see the market going in our direction, as you can see here, we can add to it. We're adding at the next pullback. So as you can see in this chart, we're simply adding at every consecutive pullback to the 55 moving average. Pulls back, boom, bounces. Pulls back, boom, bounces. Pulls back to the 55 EMA, boom, bounces, and so on and so on. All right, guys. Now, of course, there's always a risk. We always have to protect ourselves against risk, which is why we use a stop loss. So you can see in the next chart, every time we add to our position, we're also moving the stop loss. SL, by the way, the initial stands for stop loss. So every time we add to our position at consecutive pullbacks to the moving average, for example, or pullbacks to support, we're also moving our stop loss a bit higher. So we're moving the stop loss to the previous low, as we're seeing here. We keep moving the stop loss until finally the market starts to go against us. And of course, we get stopped out. So again, in this situation, we're using a trailing stop loss. And by the way, in future videos, we'll be talking about exit strategies. So guys, let's leave that for a moment. Bottom line is, guys, Linda's absolutely correct in this book, Trading Sardines, and I think she's absolutely correct. Very important. The one mistake that can destroy traders, this is the one mistake that can destroy most people, and this has happened to almost everybody, by the way, including Linda. This actually happened to Linda Rachke herself, which is never get in with a large position size, always get in with a small position size. So in case things go wrong, in case things go against you, at least you won't lose a lot of money. At least you will be protected against the risks.
Have some common sense in this stuff. That's the problem with being technical versus being emotional, and having a game plan and a disciplined methodology. So, decide you're going to risk 2% or 10% or whatever you can afford to lose. Where you put your stop should be based on how much do you want to lose. If you have a $10,000 investment and you don't want to lose more than $2,000, then put your stop there.
Absolutely. All right, guys, hope this video helps. If you like it, please give it a thumbs up and please subscribe for future videos as well. Thanks a lot. Bye for now.